The Indian stock market surprised investors in the month of April, with both the key indices, that is Sensex and Nifty, rallying more than 6%. We saw a robust pick in the stock prices, which was backed by strong corporate earnings season, and the RBI kind of putting a pause on the consecutive rate hikes that we had seen in the past. Indices that showed a blockbuster growth in this month included Realty, PSU banks, auto, and small cap. With the market sentiment seeing an uptick globally in the month of April, India also saw a revival of the FII buying, and expectation of future investments strengthened the home currency base. The positive momentum of April is expected to continue in the month of May, with a certain degree of volatility persisting due to various macro and microeconomic factors, such as the shift of the power dynamics that is fueled by China's aggression towards Taiwan, the ongoing US-China conflict of supremacy. We are also witnessing the continuation of the Russia-Ukraine war. And there is also at large a US banking crisis that's looming above us. The impact of macro factors are expected to be mitigated by positive domestic factors, acting as tailwinds for investors, including the near completion of the earning cycle, lower than expected inflation, and a pause on rate hike by the RBI. The market upswing witnessed at the back of the earnings season has the potential to help the markets recoup from the damaged economic scenario that we witnessed in the last couple of months. Despite the better performance on the home turf, it is important to remember that the stock markets can be unpredictable and be subjected to various internal and external factors which can impact its performance. Therefore, investors should carefully consider this investment goal and their risk tolerance before investing in the Indian equities. So, looking at this, let us understand if there is such a thing called right time to invest. While investing, we need to look at the tenure and the duration of the investment or the portfolio as opposed to timing the markets. Psychologically, there is this gravitational pull along the markets where people tend to sell when the markets are really low and then wait for the right time to buy, by which time the markets tend to correct itself and then they end up missing the rally. The most important factor while investing is sticking to a long-term strategy, looking at historical data. So even back, if we see the markets when it fell by 38.4% during the start of the COVID pandemic, now assuming that you had invested even at the peak of the cycle, by the time the markets had reached its highest, you would have still ended up making a 26.48% absolute return. This is what I mean by not the timing, but the duration of the investments. At any given point of time, the markets would either be up or down. A good diversified asset allocation strategy helps you to not only create an alpha during positive market, but also gives you a cushion when the markets are not moving or when there is a huge volatile period. A study conducted in 1986 by Brinson Hood and Singer on the US pension fund substantiated that more than 91.5% of the variability of a portfolio performance is attributed to asset allocation. Now, asset allocation is nothing but defining which asset classes to invest in order to return or in order to reach the return objective, at the same time managing your risk. A good strategy ensures that there isn't too much of deviation from the expected outcome. So asset classes are broadly divided into equity, debt, commodity, real estate, and then there are further broken down into stock, mutual fund, gold, bonds, etc. Different types of asset classes carry different types of risk and different potential for returns. They do not respond equally to the market forces at the same time. For instance, investing in stocks directly is considered to be a very highly risk asset as opposed to equity mutual fund, FD, or debt mutual funds that are considered as a low risk asset because of low volatility in them. Thus, while we need to work on a top down approach, that is, define a very strong asset allocation between equity, debt, commodity, and then go for a categorization within them. An asset allocation strategy with a well diversified portfolio is a key to manage risk and ensure that there is low deviation from the expected outcome. Everyone's risk taking capabilities differ, and there are different ways to measure your risk tolerance. Ensure that you understand your overall risk associated with the allocation strategy. When we are investing for a long term, the short term volatility may persist, but at the end of the day, it is the fundamental and the portfolio objective that matters. I would advise investors to understand their asset allocation strategy, to understand the risk, and don't get flustered with short-term volatility, whether it's an uptick in the stock markets or whether there is a very big downturn in it. Understand that there are rebalances that you need to do from time to time, but don't digress from the original set strategy.
Anand Rathi Share and Stock Brokers Limited AMFI registered mutual fund distributor. ARN 4478 mutual fund investments are subject to market risks. Read all scheme related documents carefully before investing.